The main elements of life insurance policies are: the life insurance contract must have all the essential of a valid contract. Must have all the essentials of valid contract. Certain elements like offer and acceptances. Offer and acceptance. They are offering and I am going to accept it. The policy and everything. So free consent. So I can consent with them. What are the policies are there and which policy will be preferable for me, and I am planning about my future. If I died, if I met in an accident, or if anything happened, or if I am planning after retirement my life and family life, if I am planning my children's education and their marriage, for everything I can depends upon this insurance company. The policy depends upon the policy, the amounts will vary and the premium will vary. So this and all I can get help from the insurance agent. Capacity to enter into the contract. Lawful consideration and lawful object must be present for the contract to be valid. It is a lawful object, lawful consideration. So everything is doing as per law. So the insurance company cannot cheat me. At the same time, I should be true for the insurance company.
I would like to remember a comedy. It is Senthil and Goundamani comedy. Senthil will act as a dead body and Goundamani wanted to claim the insurance money from the insurer, but insurer will demand to do post-mortem. In that situation, Goundamani will escape from that place and finally Senthil will be catched by the policeman.
The contract of life insurance is a contract of utmost good faith. Utmost good faith. The assured should be honest and truthful. If I get a policy, if my life is assured, I should be truthful and honest for the insurer. And giving information to the insurance company about my health condition, family members, how many of them are there, and what jobs I am doing at present, and for what policy I am taking, and for what I am taking, everything, all the information I should be given. That to truthful information, honestly I should give to the insurer company. He must disclose all material facts about his health to the insurer. It is his duty to disclose accurately all material facts known to him, even if the insurer does not ask him. Even the insurer does not ask him, we should share all the information related to us, to the insurer. In life insurance, the insured must have insurable interest in the life assured. Without insurable interest, the contract of insurance is void. So insurable interest have to be there for everyone whoever is assured by an insurance. In case of a life insurance, insurable interest must be present at the time when the insurable is affected. When the insurable is affected, so that time that insurable interest must be present over there. It is not necessary that the assured should have insurable interest. At the same time, it is not necessary that the assured should have insurable interest at the same time of maturity also. For an example, a person is presumed to have an interest in his own life. Definitely, we are presumed to have our interest on our own life and every part of it. A creditor has an insurable interest in his life of the debtors, because he believes debtor, so he have insurable interest on debtor. And the proprietor of a drama company has an insurable interest in the lives of the actors. So the drama company have the insurable interest on its actors. Life insurance contract is not a contract of indemnity. So definitely they cannot give our soul back. It is not a contract of indemnity. The life of a human being cannot be compensated and only a specified sum of money is paid. So the soul they cannot return to us. So instead of that, they can pay some money. The insurer will give some money for our family to recover from financial risk. That is why the amount payable in life insurance on the happening of the event is fixed in advance. Fixed in advance, we are paying some, what is that, premium and this and that, and we are planning for the future, the policy we are preferring, and depends upon the policy we are paying some premium money each and every month, or 3 months once, or 6 months once, or yearly once on lump sum payment, whatever it is. The sum of money payable is fixed at the time of entering into the contract. At the time of entering into the contract, sum of money should be paid. A contract of life insurance, therefore, is not a contract of indemnity. So, contract of life insurance is not a contract of indemnity, but they can pay some amount for called compensation for our family. Types of life insurance policy: whole life policy, endowment life assurance policy, joint life policy, annuity policy, children's endowment policy. So these all are types of life insurance policy. First one is whole life policy. In this kind of policy, the amount payable to the insured will not be paid before the death of the assured. Before the death of the assured, that amount will not be paid to anyone. Isn't it? After death only, that compensation will be paid to beneficiary. To beneficiary, compensation will be paid. The sum then becomes payable only to the beneficiaries or higher of the deceased. Higher of the deceased. So at the final stage or after death, to the beneficiary only that compensation will be paid. Isn't it? The premium will be payable for a fixed period. Premium will be payable for fixed period 20 to 30 years. So nearly 20 to 30 years, if it is fixed period, they should pay premium. Or for the whole life of the assured. Whole life of the assured, they should pay premium to the insurer. Then after death, that money will be given by the insurer to the family members after death of that person. That money will be given by insurer to the family members called beneficiary. If the premium is payable for a fixed period, the policy will continue till the date of the assured. If fixed period like 20 to 30 years are there, so 30 years are completed, but the assured person till he didn't die, he is still alive. But anyway, till his death, that premium will cover. So he no need to pay after the maturity period. After 30 years, then after death of him, that money will be given to their family members called beneficiaries. Okay. Second one, endowment life assurance policy. Here, endowment life assurance policy, the insurance company undertakes to pay a specified sum when the insured attains a particular age or on his death, whichever is earlier. So, it slightly differ to compare with previous policy, that is whole life policy. After death of the assured person only, that money will be hand over to the beneficiary or family members or higher while deceased, isn't it? But here, that particular person whose life is assured, if he died, that money will be given to the beneficiary or family members or the nominee who signed it. Else, if the maturity date, particular age, or if he attains the maturity date, that money will be given to that assured man. So they are not expecting till die, isn't it? Specified sum when the insured attains a particular age. When the insured attains particular age or on his death, whichever is earlier. So before death, if maturity period comes, that entire money will be given to the party whose life is assured. The sum of payable to his legal heir or nominee named there in the case of death of the assured. Otherwise, the sum will be paid to the assured after a fixed period till he or she attains a particular age. Thus, the endowment policy matures after a limited number of years. After limited number of years, if the endowment policy is matured, that after maturity date, entire money will be given to that particular person whose life is assured. Else, if he died, that money will be given to his beneficiary or nominee, isn't it? Whose name is is there in the document. Third and very important life insurance policy is joint life policy. Joint life policy, it is very useful for husband and wife. If it is partnership firm, their partners can do this joint life policy. This policy is taken up by 2 or more persons. So at least 2. Minimum 2 or more persons can take this policy. The premium is paid jointly or by either of them in installments or lump sum. So this premium can be paid by any one of them or all together. The assured sum or policy money is payable upon the death of any one person to the other survivor or survivors. It is assured if any one of them is died after death of the person, the remaining survivor will be there. For the survivor, entire money will be given. For an example, husband and wife is there. If wife died, that entire money will be given to husband. If husband died, entire money will be given to wife. If it is partnership form, minimum number of partnership is 2. So maximum so many partners will be there. So it depends upon banking business 10, other business 20. As per 2013 wise, it is 100. As per 2014 wise, 50 members. So it is the maximum number of members in the partnership firm. So they are having joint life policy. So minimum number of members in joint life policies are 2. So now 3 or more persons having this joint life policy account in life insurance. In this situation, if any one of the partner is died, the remaining partner called survivor, they can get benefit. That money will be handed over to the remaining partner. Usually, this policy is taken up by husband and wife. So who is taking? Husband and wife is taking joint life policy. If husband died, money will goes to wife. If wife died, money will goes to husband. Because moreover, many families are depends upon one head income. So if you take a family contains 4 members, father and mother and 2 kids. If the family is expecting one head income, if the person is died, met an accident and unfortunately he died. In that situation, critical situation, that family should continue, that kids should not stop their education and the family should continue without depending others and they should see their livelihood for everything they need financial support. So this insurer are ready to give financial support favor for the family if they get this policy called joint life policy, isn't it? So it is very useful for husband and wife. By 2 partners in a partnership firm where the amount is payable to the survivor on the death of either of the 2. So either of the 2, if anyone died, the amount will be given to remaining person called survivor, isn't it? Annuity policy. Under this policy, the assured sum or policy money is payable after the assured attains a certain age in monthly, quarterly, half yearly or annual installments. So here, after attains certain age, our earning capacity will reduce. If we plan now itself, after our retirement, we can get some benefit amount from insurer monthly, yearly or 3 months once or half yearly once we can get benefit from the insurance company. For a certain period, minimum number of years, we are going to pay premium money or single premium may be paid by the assured. Single premium may be paid by the assured. This is useful to those who prefer a regular income after a certain age. This is very useful for whom? Who is preferring money, who is expecting money after certain age period, called after their retirement if they are expecting regular amount from the insurer like pension. Simply says about it, if we planned about our future after our retirement, if we need money regularly 3 months once or yearly once or 6 months once, we can get benefit, we can get money from the insurer if we met out in this plan, annuity policy plan. If we are the holder in annuity policy plan, we can enjoy that benefit. Children's endowment policy. This policy is taken by a person of his children or her children to meet the expenses of their education or marriage. So the parents are planning the kids' future. the children's future, whether it may be further studying in foreign or education, else marriage. The agreement states that a certain sum will be paid by the insurer when the children attains particular age. When the children is attaining particular age as per the agreement, that money will be paid by the insurer to the kids. We can use that money for our children's marriage, else for their higher studies. The premium is paid by the person entering into contract. However, no premium will be paid if he dies before the maturity